Without further ado, I want to introduce our speaker today, David Barulich, who's president of Profundium, a mortgage company, a mortgage broker. Since 2009, Profundium has worked with owners of multifamily, retail, office, warehouse, industrial, mobile home parks, restaurants, nonprofits, cannabis, and other niche property categories to obtain mortgages for purchase, construction, and refinance. And David's a dear friend, a really good guy, and really smart, and knows how to get a loan. And today he's going to teach us how the sausage is made in order to obtain financing for multifamily or a line of credit. David, the floor is yours.
Thank you, Will. So I'm going to figure out how to do this as share screen. And so just bear with me for a second while I do that. And so let me know, do I got it working here?
Looks good to us.
Okay, great. So yeah, the title is the talk tonight, how the sausage is made. Inside the search and approval process for an apartment loan, term loan, or line of credit. So this is my contact information. So if afterward you want to reach me, it's there. And I think Will might have also had it in the invitation to the meeting. So look forward to helping anybody who has some questions about this. So what I thought I'd do is I'd start with a case study. I actually recently refinanced a property in Silver Lake, 5-unit building. It was purchased in 2005 by a married couple for $750,000. They have pretty good credit scores. And their income, you can see, is primarily from the rental income from their apartment units. They get a little bit of Social Security, some interest and dividends, but by and large, they're living on the income from this apartment building. They do have expenses, their home mortgage and their homeowners association fees. They have a car lease, property taxes on their home, and federal and state income taxes. So basically, when you subtract out all their fixed expenses, they have about $86,000 a year to spend on discretionary items or on a new loan. So that's what I have to work with. They don't have a lot of cash. They only have about $40,000 in the bank, and they have $97,000 in IRA accounts. So, but their net worth is about $3.8 million, primarily in real estate. So they resemble a lot of people that I work with in California. They like to put all their money to work in real estate. They don't have a lot sitting around. So this couple was pretty lucky. They got a great property at a low price, and now they're sort of living off the fat of the land here. So I'm just going to give you an outline of what the property looks like. It's 5 units. Here's the breakdown on the kinds of bedroom and bath mix you get. So you got a total of 5 units, 9 bedrooms, 6.5 baths, with about $15,000 a month gross rental revenue and about $881,000 a year. So they came to me because they have a lot of deferred maintenance. And as many of you are aware, there's a soft story retrofit ordinance that was passed in order to make a lot of the apartment buildings around Los Angeles more resistant to earthquake damage. So in addition to the soft story retrofit, which is going to cost probably about $150,000, they have a whole list of these other items that need to be fixed. Now, I want to call your attention to the remodel of the kitchen and bathrooms in each unit. They need to do these things, but the problem is that you can't really do it until the unit becomes vacant. And this isn't a rent controlled area, and you could see from the rental payments on those units that those folks are getting a pretty good deal. And unless they die or have a need to move out of state, they're probably going to stay put. So, but you can see there's a lot of deferred maintenance that's gone on here because these people are living off their income. They're not really putting a lot aside for capital improvements. So I'm going to look at two different ways of financing all these repairs. They estimate about $350,000 of repairs that they have to do. And so we're looking at hopefully about a $400,000 loan. And there's two different ways we can do this. One is with a line of credit, which you can think of like your credit card. You go and you charge stuff, and at the end of the month, you can pay it all off, or you can pay a portion of it. You're going to pay interest if you have a balance. And so that's what we call a revolving line of credit. It goes up and down typically. Now, in this situation, it's probably not going to go up and down. What's probably going to happen is they're going to draw on the line and they're going to build up a loan balance, probably close to 400,000. And then at the end of what we call the draw period, it's going to convert to a term loan that is amortizing. So what's nice about a line of credit is you're only using the funds as you need them. You're not forced to get a whole lump sum of money all at once and start paying interest on it. So you're only paying interest on the funds that you're using. They're interest-only payments, so you're not having to amortize principal and deplete your cash flow. You don't have prepayment penalties. If you decide you want to pay down the principal, you can, but unlike most commercial term loans, you don't have a prepayment penalty. And the total amount drawn over the draw period, where you're allowed to make draws on the line of credit, could be multiples of the maximum outstanding line balance. So for instance, if I had a $400,000 line of credit for 10 years, I could draw 1.6 million over 10 years if I wanted to, as long as I'm continually paying it off. And then I draw on it again and pay it off, draw on it again. So if you get a term loan of $400,000, that's all you get is $400,000, and then you pay it off. What are the cons of having a line of credit? Well, the amount that you can qualify for is usually less than what you can get for a term loan. And the draw period on the line of credit is usually only 5 to 10 years, after which time it matures and you have to reapply to get another line of credit. It's not like a credit card that goes on and on and on. The interest rates on lines of credit are variable. They're going to fluctuate with the prime rate, and the starting rate that when you start off today, usually that's going to be the lowest the rate will ever be. So all you can expect to do is pay more than your starting rate in normal cases. At the end of the draw period, the loan balance comes due, and you have a choice. You can fully pay it off, or you can convert it to an amortizing loan. Usually it's 15 years. And then something we're going to talk about more later, which is more of an underwriting, how you make the sausage term. We call it stress testing. When bankers look at loans and underwrite them, they assume an interest rate much higher than the current rate of interest when they determine your ability to repay the loan. And therefore, it's going to be more difficult for you to meet debt service coverage minimum requirements for a line of credit than it would be for a term loan. Now I'm going to look at a term loan. This is where you get a lump sum of money up front and you're paying it off over a period of time, amortizing usually from 25 to 30 years. And there's a maturity on these loans, usually 5 or 10 years. And at the maturity of the loan, you are obligated to pay the entire balance. So if a loan is due in 10 years and it amortizes over 25, there is going to be a balance left over in the 10th year that either you would have to refinance the loan and get a new one to pay it off, or you just sell the property and you pay it off. The nice thing about term loans is the principal and interest payments are fixed during the fixed rate period. So you have a predictable stream of cash outflows. You don't have to worry about interest rate fluctuations. The amortization period is 25 to 30 years, and therefore it makes it easier for you to satisfy the debt service coverage minimum. The cons of a term loan, well, you're paying the principal and interest on the entire amount upfront, even though you haven't spent it yet. So if it's going to take me 12 months for me to figure out how to spend $200,000 and pay a contractor, but I'm borrowing $400,000 up front, I'm paying principal and interest on the $400,000, even though I haven't even used it. It's sitting in the bank. However, and then there's on term loans, most banks have $1 million minimum loan amount, and some banks have a $500,000 minimum loan amount. Very few banks are going to lend less than $500,000 on a term loan. So if you have a low requirement for borrowing, that could be a challenge. And term loans have prepayment penalties. So if I take out that term loan with a 10-year fixed rate, amortizing over 25 years, if you wanted to pay that loan off in the first year, you could be paying a 5% prepayment penalty. And the second year, 4%, third year, 3%. So that's the drawback of doing a term loan. You really have to count on holding it for a long period of time in order for it to make sense. Now here's where we're going to start talking about making the sausage. In case you haven't heard this term, it's a very important one. Debt service coverage ratio. This in the Los Angeles, Southern California area is the primary constraint on how much you can borrow. Most of us think of loan to value as being, what I can borrow. So these clients of mine have a $3 million 5-unit building, and their thought is, hey, it's a no-brainer for us to get 1.5 million. That's only 50% loan to value, right? And well, I'm sorry, folks. It's not loan to value that really counts. It's debt service coverage, especially in areas where you have very low cap rates. This is often what governs what you can borrow. So I'm going to define it here for you so you can really understand what it is. Take the recurring cash flow from operations, assuming full occupancy, minus assumptions about vacancy rates, set asides for major repairs other than routine maintenance. So things like repairing a roof or air conditioning system, repaving the driveway. And then lastly, property management costs incurred by the lender in the event of default. So you take that number and you divide it by the recurring principal and interest payments on the loan, determined by the interest rate, amortization period, and stressed by future assumption about exposure to variable adjustments in interest rates after the fixed period ends. So this would be more applying toward the term loan, where you have a fixed period where the rates are predictable, but then after that, you're going to be stressed by assumptions of what interest rates could be doing. So this is a very important number to understand. And banks look at two ways of calculating this number. It's done at the property level, where we just look at the net cash flow from the apartment building and divide it by the loan payments. Secondly, it's looked at the global level, where we'll add the net cash flow plus or minus from the borrower's earnings and expenditures and add that with the property level cash flow. So if you're somebody who's going out gambling and you like to spend money on lots of borrowing money for fancy cars, and your personal life is very much a spendthrift, and you're essentially relying on the apartment to subsidize a lifestyle, then the bank's going to be concerned about that and look at that number. So most banks have a minimum debt service ratio of 1.2. They'll vary. Some will have 1.15, or some will have 1.25, but generally For multifamily, it's 1.2. So the easy way to think about this is if you have a $10,000 a month principal and interest payment, you should be showing recurring cash flow of at least $12,000 a month. So that 1.2 times 10,000 equals 12,000. Okay, so we're looking for that cushion for you to show that you have the capability of meeting your debt obligations over time. So I'm going to go through the example of my clients that I work with. First of all, you see their loan amount is $400,000. So they're getting under the $500,000 threshold. So this limits the universe of banks that they can talk to. In the case of looking at a line of credit, which would be sort of the optimal way for them to go if they could qualify, the interest rate would be prime plus 2% for this particular bank, which would be 5.25% today. At the end of the draw period, there would be a 15-year amortization. The length of the draw period would be 10 years. So the draw period is the period of time when you can just draw on the line up to a $400,000 maximum and just have to pay interest only during that period of time. And there's no prepayment penalties if you pay down the principal. Now, I mentioned those discount factors before. We can see, oh, I'm sorry, I skipped over to the next one. The vacancy rate assumed by this particular bank was 10%. The capital reserve was 3%, and the property management expense was 6%. So you might be saying to yourself, hey, I'm getting $12,000 a month of cash flow on my loan. That's what the bank's on my property. So that's what my bank should be looking at when it calculates the debt service. And I'm sorry, that's not correct. Actually, what the bank's going to do is take that $12,000 and discount it by 19% and knock it down. And that's what they're going to use as determining your capability of paying your loan back. So if you go and you talk to a bank and you get frustrated because they're offering you less than what you expected, that's because you're not aware of how the sausage is being made. These are the assumptions that they use. So in the case of my clients, I went to the lender and I said, look, guys, 10% vacancy assumption for Silver Lake and rent controlled area, that's insane. I want you to knock that number down to 5%. And I want you to knock the capital reserve from 3% to 0, because after all, the whole point of this loan is to do these long-term capital improvements. So, that's what we're using the money for. So it doesn't make sense for you to even assume that 3% number. So I could knock that 19% number down to 11%. And since I'm a commercial mortgage broker and I know how the sausage is made, I know how to negotiate these terms. So for my clients, they're going to be able to qualify to borrow more money because I know what to badger bankers about. When they're just using a formula that doesn't conform to the reality on the ground we're talking about in a particular circumstance, that's when you have the capability to make an argument. So if I look at the gross net operating income of $106,280 and I discounted it by the 19% assumed by the bank, that takes you down to $86,087 annually that's available to be servicing the loan. So if I was going to do a $400,000 loan at 5.25%, that would be $3,216 a month. Well, the debt service ratio on that would be 0.92. That's way under the 1.2 we need. And if I stress tested it at 7.5%, the debt service goes down to 0.81. So $400,000 is just not a realistic option for my clients in this situation for a line of credit. If I instead dropped it down to 300,000, then we're getting closer to qualifying. You can see that the unadjusted debt service would be 1.23 And if we stress tested it, it would be 1.07. So that we could handle. We could do $300,000 for my clients. So now let's look at a scenario 2, where instead of doing a line, we're going to do the lump sum term loan of $400,000. Well, the particular bank I talked to for this option was offering a 10-year fixed, 4.125%, amortized over 25 years. And they had the same discount factors, but it didn't really matter because my clients, given these assumptions, were still going to more than qualify to get this loan. So I didn't have to fight so hard arguing to discount the vacancy and capital reserves to a more appropriate number. So in the end, what we wound up doing is getting them a $400,000 term loan. So because that seemed to be more, it got them more of the money they were going to need, and it was at a really attractive interest rate. So the challenges to consider when you're shopping for a loan for a multifamily is be cognizant of the minimums that banks have for loan amounts. Typically, it's $500,000. You might get pricing breaks at $1 million or more. My borrowers had limited liquidity. They were going to be very vulnerable to any shocks. So if there was an unexpected damage to the building that they had to repair, all they had was $40,000 cash in the bank and $97,000 in IRA accounts, which you have to pay tax on when you make withdrawals. So they were really not in a position to be responsible real estate investors and be prepared to handle shocks. So I thought it was prudent to get them the term loan so they could get some added liquidity and comfort, since most of their income is derived from their apartment building. Now, the renovation of the kitchens and bathrooms is going to depend upon the tenants vacating the units. So a good portion of that money may not be used to remodel those kitchens and bathrooms unless these tenants move within 10 years. So that's going to be the drawback for this loan, but at least they can keep the money in the bank and earn some interest on it. Now, here's why this loan was right for my borrowers. I kind of went over this. Their rate is fixed for 10 years. They have a fixed $2,139 a month and $25,668 a year principal interest payment. They have predictable cash outflow. And because they're risk averse, they have low liquidity, this was really the best way to go. So the keys to shopping for a loan. Understand the banker's point of view. How is the sausage being made? What I do as a broker is I provide an Excel spreadsheet for the bankers so they can do what-if scenarios using their own specific assumptions at their bank. So I spread all the information from your tax returns, financial statements, and the earnings from the apartment building, and the bankers can easily calculate what the maximum amount is that you could borrow at a certain interest rate and over a certain period of amortization. So that's how I'm able to easily shop loans, because bankers love to work with me because I make their job easy. The other thing is, don't let multiple lenders run credit reports on you. Bankers really want to get you to fill out their application, which contains a sneaky little authorization for them to run your credit. So imagine if you're trying to shop 4 or 5 different banks, and the 5th bank in line sees Wells Fargo, Union Bank, Chase, whatever. They see all these different banks that ran credit reports. What does that banker think? He says, "Hey, I'm the 5th guy in line. Why am I so lucky?" So you don't want to have that happen to you. The beauty of working with a broker like me is I'll run a credit report on you once, and I can shop you with 5, 10, or 15 different lenders. And the only time they're going to run a credit report is when we pick the bank that wins the competition. They're going to have to run a credit report to actually close the loan. You also should understand your strengths and weaknesses when you go into a deal. So my clients, their strength was they had a very low loan to value. That was the strength, but their weakness was their cash flow. So, don't ask for things that you don't have the ability to deliver on. Understand which are the deal points that you can negotiate. For instance, the capital expenditure discount factor and the vacancy rate. And also, when you do shop for a loan, shop in parallel, not in series. You want to shop with multiple banks at the same time, not one after another. Don't go with one bank and it takes them 3 or 4 weeks to say, I'm sorry, we're declining you, or we're going to offer you this, too high of an interest rate. And then you get frustrated and you go on to the next bank. So the beauty of working with a professional broker is that you can have them make a market and get you the best deal. And that concludes my presentation. And if you have any questions, I'd be happy to take them at this time.
Thank you so much, David. I know we have some questions in the chat. If you want to stop sharing the presentation now, and then we can go back to seeing everybody and people can start asking questions. Ray has a question. If you have different entities, like different LLCs for liability reasons, how does that work in terms of all the sausage that's being made?
So I'm assuming that you own multiple properties, and the question is if I'm applying for a loan on one property. So that's going to be part of the global cash flow calculation. So I've worked with investors that own 20, 50 properties, and it's a real pain in the butt to do the cash flow analysis because there's a lot there. But the bank's going to take that all into account. The beauty of somebody with a portfolio, a large amount of real estate, is that I've done this for clients where I'll get a large line of credit from a bundle of different properties. And let's say I get a $3 million line on a collection of properties that's worth $6 million. You can take that $3 million line and then you can walk into a negotiation, say, I'm paying all cash to buy this property. You buy it with a draw on the line of credit. Then after you bought it, then you go out and get the term loan on that property. You pay the line of credit down. So now your powder is dry for the next round of purchases that you want to make. So that's a good strategy to adopt in those situations.
It's a very good strategy. I've definitely had many investors use that strategy. So that's very, very smart. August, do you have a question?
Yeah, sorry, I have a few questions. What are the typical broker costs that you charge, or most of it's passed on to through your lender?
Yeah, so the way I work is I have an agreement with my clients that sets my commissions. Typically, it's 1 to 1.5%, depending upon the difficulty of the deal involved. And the reason I do that is because the banks that pay broker commissions have the worst terms. If you want to work with the highest quality banks giving the best rates, you want to work with a broker where you're paying them. And so that's the way I work. And there's a lot of banks that offer incentives to brokers to bring the deals to them, and they pay them 2% commissions, and that's got to be priced in. There's no free money out there. So that's how it works.
And then I'll probably, if you can share your contact information with the group, that would be awesome.
Sure.
And then I had a question from your experience with ADUs now being available on like multi-units. So, right, you can add a couple ADUs to let's say a fourplex. From your experience, does that change the definition? Does that fourplex become a commercial property because it has 2 ADUs, or the ADUs don't count in terms of the bank's eye as making it a 6-unit commercial property now rather than a 4-unit with 2 ADUs, therefore you get the non-commercial loan? Do you see what I'm saying?
You're asking that to me, August?
Yeah, like, have you had experience with this? Because
I've not seen that. I'm curious to know if the city zones parcels differently based on whether they're 1 to 4 units or 5 or more. So if you had, I don't even know the answer to that question. Will, do you know if there's a zoning?
So, I mean, my understanding is you're not changing zoning, right? I mean, if you have an R2 lot, like a duplex lot, right? And you decide to build an ADU, and let's say they allow you to do a junior ADU, right? So you're adding 2 units, right? My understanding is those are considered ADUs. I mean, I'm not aware, but I mean, this is fairly new, right? We still don't really know how a lot of the banks are handling this.
Mhm.
Right, because I'm looking to, like, I'm adding two ADUs to a fourplex.
Yes.
And I'll probably get like a 400,000 loan.
Yeah.
So part of me is like, I think I'll just get that loan, just, for improvements with my current bank, and just refinance the entire thing rather than doing it after the case, because then I'll probably have to switch to a commercial loan, and then I'll be like looking for a new loan every 5 to 7 years.
Yeah, I want to bring up a point about there's a difference between a commercial loan and residential. If you look at my clients, their home that they currently own is worth $1.2 million, and they have a mortgage of $484,000. So, in terms of loan to value, they could have qualified for a $900,000 mortgage had they had sufficient income, and that would have been the cheaper way to raise $400,000. However, because of the rules for residential underwriting, which look at your income and as a debt to income ratios, they couldn't have qualified that for that kind of a loan. So it's interesting when you use commercial underwriting, you in a sense get a more permissive environment to qualify for borrowing than you would under the residential lending. So that's something to consider.
Okay. And what, when you say getting competitive rates, like for commercial properties, what do you think is competitive right now?
Well, for this loan, $400,000, so it's under 500,000, under $1 million. I mean, if you're doing $1 million loan, there's people doing 10-year fixed, and for like 3.8 or something like that. I mean, yeah. You can get stuff. A lot depend. It's all circumstantial. If you're a good customer, you're a recurring customer at that bank, and you have a portfolio, you could maybe get 3.5 or less. I got somebody 3.5, 15-year fixed, 15-year amortization with at 3.5%. So the shorter the amortization period, the lower the rate too.
Awesome. Thank you for that.
Thank you, August. Chris Crosby, you had a question.
Yeah, so David, you had mentioned some of the differences between the 2 to 4 unit space and the 5+ space, commercial versus residential and financing. Mm-hmm. Because residential financing 2 to 4 is really focused on debt to income of the actual individual, do you have any recommendations for an individual that may have a high net worth, for example, north of $1 million, but just recently switched from a W-2 to starting their own business or being an independent contractor? Essentially, they don't have 2 years of tax statements to prove the income. Any recommendations for someone like that, trying to get into the 2 to 4 unit space?
Yeah, I'm sure Will and I both know some great residential mortgage brokers who do bank statement qualification rather than tax returns. Those kinds of loans are going to be, they're not going to be the 2.75% 30-year fixed, obviously. But you can definitely get qualified. And also there's a underwriting technique where they can look at a lump sum. If it's liquid, they can assume an amortization period based on your lifespan and use that amortization of your capital toward counting as income for underwriting. So yeah, there's lots of different techniques for working with these situations. But Will and I both know residential mortgage brokers who can I'm strictly commercial. I'm only doing multifamily, warehouse, industrial, office, retail. Don't do any owner-occupied residential mortgages.
Yeah, that would be a great referral. I'd appreciate that. I always come across, new business owners that should be able to buy property, but can't just because of the income aspect. So thank you for that.
Ray, Richie, you have a question?
Yeah, if you have a couple $1 million of equity due to the increase in value of a couple of multifamily properties, with inflation, let's say going to be 10% around there, what strategy do you recommend? Take the money out and use it to buy something, or take the money and start investing, fixing things like roofs, et cetera, or what?
Well, that's beyond. I'm not a wealth advisor, and I after 2012, I stopped making predictions because I was kept on being wrong about saying, oh my God, the money supply is jumping up. We're going to have 12% interest rates, and then they drop below 5%.
Well, assume it's 10%, and you're going to have low interest rates for like another year at least.
So
yeah, QE7, I think.
I would say that banks have a problem with doing cash out refis unless you can demonstrate how you're going to use it for commercial purpose. Now, this is a regulatory issue because there's a difference in lending law between consumer loans and commercial loans. So if somebody says, hey, I'm sitting on a warehouse here, it's worth $5 million, I don't have any mortgages on it. You know what? I feel like buying a few Ferraris and taking a long vacation. Let me cash out $1 million. The bank's not going to want to do that loan because it would run afoul. You'd have to do Reg Z, Truth in Lending Act, and then it gets kicked into the consumer loan division of the bank. So my case with my clients, there was a clear demonstrated need for how the money is going to be used. Now, nobody's sitting over their shoulder to make sure they're writing the checks out to the right person, but at least you have to have up front a reasonable story to tell to justify it as a commercial purpose loan. So I do work with banks that are comfortable with real estate investors that want to pull money out to buy other commercial properties. So that's an okay use, but the universe of banks that are comfortable with that is kind of small.
Thanks.
Okay.
Are there any other questions? David, I have a question for you. I work with a lot of investors who want, are interested in buying value add properties where they, usually rent control buildings that have below market tenants. They're interested in, doing buyouts, doing some, remodeling, repositioning that building. Are you seeing loans that include any type of construction budget or, buyout budgets? And if so, what kind of terms are you seeing and with those types of loans?
Yeah, typically the way that that is structured is, what we call an earnout. As you fill up a vacant building, you qualify to borrow more money. Usually what the lender does is they have an interest only period of time for, let's say, 12 to 24 months. So that way, instead of amortizing principal and having a larger cash payment to make, you have, you're paying less on a monthly basis. And then once you have filled up the vacant units or made some improvements, then we can start amortizing the loan at that point. The other way it's done is what we call an interest reserve. So you're actually borrowing money because in the beginning, you may not be able to make any interest payments because you're going to have to be out of pocket to make the improvements to the property. So, you might borrow $1 million toward a $1.5 million purchase, and that goes to the seller. But then we're going to throw in another $200,000 into a restricted account that will be set aside and used to make your principal and interest payments on that loan. So you're paying interest on money that wasn't paid to the seller, but it's there to sort of help you through that period of time. The money could be used for interest payments or made directly paid to a contractor who's going to do improvements. So those are ways we can deal with those situations.
Okay, very good. Yeah, like I said, we have a lot of investors that come to us who are looking for those types of scenarios. So definitely send them over to you to discuss. Do we have any other questions with regards to how the sausage is made? Ray.
Can you explain to me just how it works, or the mindset or the process where basically you want a fixed rate for 10 years and then it's going to be who knows what? What's the strategy that people deal with that? Or is there one?
You know what? Anybody who's in real estate development is always taking risks. If there weren't risk and uncertainty, there wouldn't be any money to be made. So that's kind of my snarky answer. But the bank will do a stress test to say, okay, when the 10th year, the 11th year rolls around, the loan is due, and you have to go back on the market to refinance it, we're going to say, okay, the interest rate could rise from 4.1 to 6.5. If it did, how would the rents in your building be able to service that new loan? That's basically what a bank tries to do. I mean, it's, you know, who knows what the future is going to hold. 10 years ago, interest rates were probably around 5%, and now they're lower. Okay, so stress tests would have been overqualifying you. So nobody knows the future. We just do our best. We have these rules in place to sort of minimize defaults and stupid loans, and gives auditors things to look at and pick at in the bank's portfolio.
So is a typical thing you refinance like every 5 years or so, or depends on the interest rate?
Well, I try not to put my clients in loans that have that short of maturity, but the maturity of the loan is governed by the period of the leases. So apartments are a little different from other kinds of properties, but if you're doing, because we're assuming that people are going to, you know, be renewing their leases in their apartments either a monthly or annual basis. But when it comes to retail or office buildings, then the lender is really looking at the length of the leases in place. And if you have a lot of leases expiring within 2 years, they're not going to give you a 10-year fixed. They're going to probably give you 3-year or 5-year at the most. So you will be forced to renew the loan, reapply.
And how do apartments work?
What?
How do apartments work, multifamily?
Apartments, we're not looking for the long-term fixed leases in apartments. We make the assumption, we just kind of assume a vacancy rate for apartments. That's how we kind of deal with the problem of turnover. But other kinds of properties, we definitely look to the lease, especially if it's a single tenant property. Then you're, you know, as Will mentioned in the case of the resident, you know, having a home versus having a duplex or fourplex, you got a vacancy in a single tenant property, then you're really up the creek. So those are more risky. And then we're going to be much more concerned about the quality of the tenant and the length of the lease.
Absolutely. Do we have any more questions for David?
I think Jim has a question.
Jim?
Yep. Sorry about the noise on that side, but I historically have been investing in 3 and 4 unit properties. I've been shying away from 5 to 8 unit properties because I've never done a commercial loan process. Would you say that the initial cash outlay and the paperwork and process are better, worse, easier, harder for a commercial 6 unit versus a triplex?
I only work on commercial, so I couldn't tell you the pain and agony involved in 1 to 4 units. I don't know, but my impression is the 1 to 4 unit world is much more of a factory. It's more homogeneous. So in some ways it's easier, but in some ways it's harder, because if you don't fit inside they're round holes and you're a square peg, then you're out of luck. As you can see from this example, my clients wouldn't qualify for a residential mortgage of $800 or $900,000. Essentially, right now they have almost $900,000 of debt on their balance sheet, but because 400 of it is in commercial, they were able to qualify. They couldn't do it if it was 900 on the residential side only. So I'd say commercial is probably more difficult because it's less standardized, but in some ways it's more flexible. So you get something for paying the price of more complexity up front.
I agree with David. I have holdings both 1 to 4 units as well as 5 and above, and everything that David said I concur with. Like, definitely from 1 to 4, it's much more cookie cutter. They're looking at your straight up balance sheet and your debt service ratio, all those things, you know, within your own salary. They're not as interested in the property itself. Whereas with the 5 units and more, they're looking more at the income of the property and how that fits. And so there is more flexibility in it. They may require higher downs, you know, but there is definitely more flexibility in it. So there's kind of pros and cons to each one.
Cool, perfect. Thank you both.
Is there anyone else that would like to ask a question to David?
Well,
If not, I just want to remind everybody, we do have, like I said, a couple more seminars this month. You know, I have one on TICs coming up next week, another one on incorporation. I think we're planning to take August off for summer, you know, just give everybody a break. And then hopefully we're hoping to get back together in person in September, I think. Is that correct, Anthony?
Yeah, I think so. I'm planning a design panel that's going to have architects, contractors, designers talking about all the different trends that are happening, the cost to do different things. It'll be hosted at the Pacific Design Center, so that might be our first kind of back to normal meeting in September. So stay tuned for that.
And I just want to thank David Barulich from Profundium. We're going to email you all his PowerPoint and his contact information so you all have it. And want to thank him for taking the time and sharing his expertise with us.
Yeah, great job, David. Thank you so much. Fellow
Thanks for
Croatian.
having me. It's a pleasure to speak to this group.
Yep, thanks a lot. Really appreciate it.
Absolutely.